right, so we have, yeah, you're able to see the email, right? So we just go to the JD, which is this one. I'll just discuss the JD quickly. I presume you've read. So the first rule is, of course, everyone, please read up as much as you can. There is a informational leaflet on ACP. Uh, it's partners, I guess, the last word. Yeah. So, or AKP actually. So please read up on this. So the first rule is that you must always, for any client that you're visiting, whether you're actually working as a, when you start working in industry, or you're going to, and this applies also to company interviews. So if you're going to a company interview, your goal has to be to blow the company away with the amount of information you've gathered on the company. You have so much information these days on the internet, so you can easily gather information. You must always try to do very good homework before you go for a meeting. It shows respect for the occasion, and generally most people don't do it. So if you do it, it helps you to shine. That's one. Okay, so strong leadership. Commercial banking team. Okay, so understand this is commercial banking. So let me just see one sec here what we have. Just hold on. Okay, let me try and see if I can get some. So commercial banking, I hope everybody knows what commercial banking. So please make sure you understand what commercial banking is all about. And so obviously this is the core business of lending and borrowing. So you have borrowings from deposits uh, by taking deposits from the public, and you're lending money by giving facilities. Usually the bread and butter business of commercial banking is short term. So understand the business which you are going to, which is that the classical commercial banking business is you take deposits from members of the public, like people like you and me, and also from very cash rich corporates. And you take, that's how you build up your deposit base. And then you take that money and then you lend that money out to corporates who needs working capital finance. So working capital finance is actually let me see if I can actually create a document here, which I can share with you, so that your calls tomorrow, your calls are going to start coming around afternoon, I guess, something like that, right? Let me see if I can show you somewhere here. Okay, I'll create it here and then I will just folder here. Okay, so you have to first look at the business you're joining. First, make sure you understand the company very well. Study the company very well, all the stuff that they have put out in the brochure, and also go to their website and find out. This is, I think, Moody's, what used to be Moody's, from what I heard from Faraz. And so look that up and research the company, then understand the business they're in. Commercial banking, you should understand, is the core commercial banking business. And the core commercial banking lending product is actually short-term finance. The banks are normally not in the business of, the traditional business of banks from the lending side, you look at the lending side, is not really long-term financing. Those are done by the term lending institutions, etc. But and usually that is done through the capital markets, not the finance, the commercial banking side. The commercial banking, generally banks focus on working capital finance, so various types of overdraft facilities, etc. And so here I would recommend that if you go to, let me first set up the document first, okay? And then I will share the document and I'll just email you the hyperlink. And let me first put the document in, because otherwise it. So let's look at this first. Let's put some core commercial banking business. Later on, I'll share this with you through the hyperlink, and anyone can read it from the hyperlink. So let's look at this. Here, what are we saying? So company, okay. AKP, the company, research the company, then commercial banking, okay, deposits, deposit taking, and uh, lending to corporates, which is usually working capital and other short-term financing. Typically, a bank financing is supposed to be all repaid within a year. Not exactly, but somewhere. I mean, that's basically the idea. So short-term financing. And so this is, in a way, you can say commercial banking is an alternative to capital markets. We did not have time to discuss all this in detail with you, but commercial banking is an alternative to capital markets because to some extent, okay, because there is other stuff like to cap markets where you can go for things like commercial paper, etc., which we don't have a very developed market in India, but in the US and all, it's very developed. So it's an alternative to capital markets where companies can issue commercial paper, which is a very big market in the US. And remember, I think from the impression I get of this job, okay, let's look at this. Yeah, they're talking about MD&A. I think they're talking about 10Qs. I suspect that this is a, what do you call that? Those KPO type of company. So I think that they would be doing a lot of work for US banks or at least international banks. So therefore, it's not going to be typically India-based. So you would have to have an understanding of the international capital markets. So therefore, understand the basic stuff here, which is that in capital markets, you can issue things like commercial paper, which is a discounted money market instrument. Okay, discounted money market instrument, which basically doesn't pay coupon. Okay, no coupon. This is the characteristic of money market instruments. No coupon and original maturity is less than 1 year. This is the characteristic of a money market instrument. And commercial paper is one of the big. So commercial paper is a classic example of what we call disintermediation. Okay, so this is basically commercial bank disintermediation. Commercial paper is an example. So understand the business example of. So I'm just giving you a little bit of a broad overview because you have to understand the space in which you're operating. This is an expression we use. I don't think we've had a chance to discuss all this because we did not have this chance to discuss many things. We actually need double the number of courses to cover even basic finance. Financial disintermediation. You should know this term with respect to commercial banking. Because what is the commercial banking guy doing? The commercial banking guy is basically taking money from people like us, deposits, and also from cash-rich corporates, and building up their liability side, and that's the money that they have, and then they using fractional reserve banking, which you have already studied in your economics courses, where you can't lend out. If you take $100 in deposits, you can't lend out the full $100. You lend out a fraction of it. So you lend to corporates, giving straight working capital finance, financing inventories, receivable, etc. And also you give them other types of plus non-funded facilities. The working capital finances, then you have these working capital finance, just straight lending for covering your working capital gap and all that. I presume you've covered all this in your Finance 1, Finance 2 somewhere. And non-funded facilities are basically where money is not directly being lent. Okay, so this one example is letters of credit. Okay, I would suggest letters of credit plus guarantees. These are called non-funded facilities. Here also the banks make money by charging fees. So I'll give you a guarantee, maybe $10 million guarantee, but I will charge a fee of some percentage, maybe 1% or whatever of the amount of the guarantee. That's my fee. That's a clean, that's clean income for the bank. No risk taking as such. Well, of course, there is a risk if the guarantee is invoked. So please understand this term, non-funded facilities. Okay, working capital is a funding funded facility, and then you have non-funded facilities like letters of credit and guarantees. I would suggest you try to read up a little bit on letters of credit. Try to understand this product. We did not have a chance to discuss it properly. Please try to read up on letters of credit. Here, what happens is basically a bank opens a LC. These are called LCs. Opens an LC in favor of. So if you have a company, let's say maybe you have a company that is importing some material from Switzerland. So the Swiss supplier doesn't trust the Indian customer, and so he wants, but he doesn't know the Indian customer, but he knows SBI. So what he does is he says that, okay, I need a LC, I need a import LC from your side. For the Indian customer, this will be an import LC. So he opens he asks the Indian customer, I'm not going to ship to you just like that. I need a LC. So this customer will have to go, the Indian customer will have to go, maybe it's Bharat Forge in Pune. Bharat Forge has to go to SBI and ask them to open an import LC in favor of the Swiss supplier. Let's say whatever, maybe whatever the company is, okay? Uh, and the company, so SBI will open a import LC favoring the, with the beneficiary being the Swiss supplier, where basically SBI is guaranteeing. Now SBI may be having may have Bharat Forge as a client, and so SBI will say to the customer that I will pay you as soon as you have shipped the equipment to Bharat Forge in Pune. Once you put it on the ship, you have a bill of lading, etc. These are documents of title, etc. Because you have other documents of title. So if you give me the documents of title, you give it to SBI Zurich. Then, as soon as you give the documents to SBI Zurich, we kind of effectively have control over the goods. So what you do, as soon as you give the documents to SBI Zurich, we will give you the money. We will release the payment to you. So this is SBI is talking, and of course SBI will be not talking directly to the customer. SBI will be talking to some Swiss bank like maybe UBS Zurich, because the bank-to-bank communication is quite well established. So this is how the system works, and UBS Zurich is the banker for this other shipper in Switzerland. So this is how the letter of credit system works. Without this, international trade will just kind of collapse. Okay, kind of like what is happening with the, imagine no letters of credit means that ship is stuck in the Suez Canal. That kind of situation. So it will really, this really greases the wheels of international trade, because customers don't want to ship to unknown customers. Exporters don't want to ship to unknown customers here and there. So this is the system. So please understand the letters of credit system, how it works. It is an important facility for the bank. And then you have lots of other related products that they can sell around it. Okay, but here this is mainly, this seems to be, when I look at this, it seems to be mainly, so as a commercial banking team means you're going to be supporting, you're going to be providing research support to the RMs actually based in wherever they are based. Okay, so try to also look at, go to a big bank. Let me try and do this here. JP Morgan Chase or somebody big bank, and try to see what kind of, because these are going to be your, you're going to be working for a KPO, and you're going to be, try to go to their, if you go to JP Morgan Chase and we look at their website, very big bank obviously, and did not get hit too badly by the financial crisis, but they lost a lot of money in the London rail disaster, about 6.5 billion. Now, let's look at this. Go to a bank like JP Morgan Chase and try to, who are we, who we are, what we do, etc. Try to read this, try to understand investors, careers, no, who we are, okay, and try to figure out here where they have, if they talk about the products, okay. You can read some of the annual reports. I don't know how much time you'll have, but try to figure out, changing the pandemic, what are they doing to small businesses? Okay, what are they doing? What can try to figure out their basic products. Okay, here you'll also get some opportunity, hopefully, to learn about LCs, etc., letters of credit, and other products which they have. So try to go to a big bank, because this is going to be your customer. So you're going to be working for these big banks, and you're going to be, well, in the sense that you will be, so the commercial banking teams within the big banks, they will be using research support from companies like AKP, from what I can understand of the business. So you will be basically acting as a research support analyst for the relationship managers who sit within the corporate banking units of banks like JP Morgan. And so what they're doing is they're analyzing various corporates, which is what you're going to be doing here. Analyzing, spreading the financial statements, and trying to decide who is credit worthy, who is worth what kind of risk. Okay. Did I share with you the credit ratings from while we were studying in IFM? Did I share with you the wiki, the corporate treasurers wiki? Did I do that? Can anybody inform me? Yes. Do you remember that I shared the treasurers wiki? I did not. Okay, 1 minute. Treasurer's Wiki. Let me get that. Okay, so this is now who is the treasurer? Now think about your business. You are basically there as research support for relationship managers within the corporate banking teams of big banks like JP Morgan. And instead of doing their own research now, they're outsourcing the research to equity knowledge partners, and that's where you're going to be working. So essentially, you're like the research support for the RM indirectly. And so, what is the RM? What is the RM concerned with? RM is concerned with various corporates and trying to sell them as many of their corporate banking products as they can. Working capital facilities, other short-term financing. Nowadays, banks are also involved in a little bit of medium-term, long-term. They have syndicated loan desks and all that. But mainly, bread and butter corporate banking is working capital, short-term. So essentially, assessing, you want to be able to assess the credit worthiness of your customers, potential customers, plus giving the know. So you should know the product. You should know the product group. I mean, you should know the product suite. What are the products that your RMs are selling, which you're supporting the RMs? What are they selling? So you should know traditional banking products, full range of products, so treasury products, okay, which means you should also have an understanding of derivatives, which you have already now. You can study that book, Risk Management Solutions, which I've written, where you'll find a very good understanding, a very good coverage of. Now, those are typical, products which are sold by banks, especially the interest rate swaps and those kind of things. Those are the treasury products, okay? These may not be a direct focus, but you should have that awareness. Mainly, you're trying to assess here what is basically the credit worthiness of these customers, so that the guys in the corporate banking teams here can figure out that, okay, we want to lend to this guy, this is a good credit. Okay, so you should also come to this. Let me look at this, and later on, of course, I'm going to share all this with you. Okay, so in the Treasurer's Wiki, let me now bring this here. Credit ratings. I want you to understand credit ratings, because this thing is nothing but all about credit ratings. Usually apply to not to the money market instruments. Credit ratings usually apply to capital market instruments, okay, where this is where your credit ratings typically apply. Your AAA, AA, etc. This is where your credit ratings apply, but the concept is the same. Whether you are you're looking at credit rating for a particular bond issue, which is being floated in the capital markets, or you're looking at credit rating and doing a credit analysis for a short-term financing with a corporate as a corporate banking guy. Just a small difference of time frame, not much. Otherwise, the focus is the same. We're trying to assess the liquidity position. What is the operating cash flow generation capacity of the company? That's basically the focus. Okay, try to understand that. Now, under the Treasurer's Wiki, you will find there is a where is that main page about the wiki? Okay, listen. Now, who are these guys? Who are these guys? Okay, these ACT, Association of Corporate Treasurers. Who are these guys? Now, these are the corporate treasurers. So when your JP Morgan relationship manager goes to market his products, where is that thing? Okay, can't see now. The website is, maybe my browser is not working too well. Business savvy makes big heart. Okay, anyway, never mind. I can't even click on it. Oh, these are all funny. None of this. Okay, small business changing with the now. I don't know what they're doing anyway. So they seem to be, basically the idea is to go to a big bank website and try to figure out their products. Now, on the treasurers page, who are the treasurers? These are the guys who are the CFOs and the treasurers of the customers of the corporate bank. So your customers, you are basically like, you have to think of yourself as being attached to the RMs of the commercial bank teams. Okay, so you're part of the commercial banking team indirectly through AKP, and the guys that your team is actually trying to sell to, their treasurers, their gatekeepers, their treasurers, like CFOs. This is basically what it is. The corporate treasurers. This is for them. And so here, what we are trying to find out is there is in the if you look at the main page, there is actually a page where you can, okay, maybe it's this is the one I was looking for. This one. So here we have a page where you have credit ratings. So please make sure you understand credit ratings and have some basic idea of the credit ratings here. There is a lot of very good information here. Now, these are the customers that your team is selling to. Okay, the RMs of this. So read this, a very good resource. This is the association of those treasurers. Here you can see there must be something about, I don't know what is happening with the display. The Chrome displays are not very good. Let's look at all of these articles are worthwhile, but the one particular one I wanted you to look at is corporate finance, introduction to debt securities. So all this is classic stuff that you guys are going to be looking at. So you must understand, I don't know how much you can read, of course, in this short period. Obviously, you don't prioritize equity capital because this is not your focus. Your focus is really loan finance, and look at all the corporate banking focus, this one, okay? Credit ratings, this one you try to understand. Anything, your goal is basically, remember that the corporate RM's goal is, RM is relationship manager, goal is to assess credit quality, okay? And credit quality essentially means that short-term liquidity and operating cash flow generation capacity of the company. That's what we're talking about. Uh, so this is what we are interested in, operation cash flow. So you do your, okay, so this is basically, this is the whole business. So I'm just giving you a rundown on the business so that you have a good understanding of what you're getting into. And here you should open these up, have a sense of it. You don't have to memorize the ratings, but you should, now here you see export credit agencies. These are all what is the credit rating. Here you'll find that there is certain information. You know where the ratings are. These are the ratings. Now you are going actually to Moody's, right? So understand that you're going to Moody's. Sorry, there's some background noise. Just ignore it. You're going to meet Moody's. Okay, long-term, short-term ratings. So you can talk in the Moody's language. You can talk in the Moody's language here, and have this. So don't have to memorize, but get a feel for what's going on. Investment grade, non-investment grade. India's rating is right now just here, Baa3, just about investment grade. One more downgrade, and we are going to go into junk status. This is called junk rating. Non-investment grade is junk rating, and this is investment grade. So have a sense of the basic breakup of corporate credit ratings. Although these are applied to capital market securities, not to the banking, but the banking products, but still it's the same kind of focus, assessing credit quality. So therefore, here what you should do is, so just try to use this resource if you can. Okay, try to learn as much. Obviously, you don't want to waste your time learning about equity for this kind of interview, because at this stage you're focusing on credit analysis. See, credit appraisal process. So this is basically what you're going to be doing. Okay, so understand the nature of the business. So therefore, practice going through go and do some this MD&A is management discussion and analysis. So this is all the stuff that I used to tell you about how you should tune into the earnings calls and things like that, where they discuss all the prospects for the company, etc. So you have to basically be able to assess the short-term, liquidity position of the company. That's your focus as a relationship manager. So calculating all these financial statements. So make sure you understand your ratios very well. And you guys have already done some work, I guess, on the financial statement spreads. But I think this year DG sir was not teaching. So you have a new faculty for your course. I know how DG sir was teaching this particular course. That would have taken you through a lot of the Pandey sir, that is. That would have taken you through a lot of these kinds of exercises anyway. But I don't know how the new faculty is teaching it, but whether you're doing spreading on spreadsheets and all that. But more important than the spreadsheets, don't get so caught up in the spreadsheets, because we are seeing some people in the admission interviews who have done some courses on financial modeling, etc. Now, all they have done is basically they have done some work on spreadsheets, but their concepts are not clear at all. So focus on spreadsheet is just a tool to make your job easier. You can do the same thing if I don't allow you to use a computer. You can still do it by hand. It will just take you a lot more time. But make sure your concepts are clear. Liquidity ratios, please understand all the different types of ratios. Okay, let me go to one more time. Let me go to FinViz here. On FinViz, you will see the connections to, we have used the FinViz screener. The point I want to make here is that I want you to go to the ratio analysis. Your ratio should be like inside out. Okay, it's like doing WhatsApp. You should be able to do your ratios like WhatsApp. Okay, and let me try and get this here. No, one second. Yeah. So when you go into FinViz, and if you just go into, let's say, any company, let's say we go into what is happening? Oh, this one is not yet loaded. So ratio analysis is very important. Make sure your concepts are very clear. Not so much on using spreadsheets. Okay, that's a lot of people. What they do is they mindlessly apply some formula in the spreadsheet. But if you ask them about the formula a little bit, if you probe them, their concepts are not clear. Because the focus is not on conceptual understanding. The focus is not doing some fancy spreadsheet work. That's not the right focus. Concepts have to be clear first. Spreadsheet is just a tool to make your job easier. Okay, you must know what you're doing and what your focus is. Focus is short-term credit quality assessment, and understand that this is very different from a assessment of what we call, market potential, like the equity analysis. This is the equity prices. These are of course indices. And if you can look at, let's say we look at any company now, Pfizer, we can look at Pfizer, and Pfizer is a, the pharmaceutical giant. I think they're also involved in the vaccine development. So you can have, well, of course, it just went there. If you go to pharma, stocks are not going too well. Let's look at we'll have to just put PFE, let's say. You do PFE, you do Pfizer, you look up a company and try to look at their balance sheet, and then there is a ratio. The reason I'm going through this is that Reuters has a nice, if you try to look at their ratios, okay, some of their other ratio analysis. You have some information on the views on the back. Here you can see all these downgrades. Where is the, there is a link to the financial analysis, okay? Try to find it here. I'm trying to find where this, there is a link to the financials, okay? Try to find the link to the financials. And it's all I'm saying is that you go through your ratios, make sure you understand all the various types of ratios, liquidity, profitability ratios, but mainly your focus is on liquidity ratios and operating efficiency ratios, because you're trying to assess short-term credit quality. So operating efficiency, your financial, liquidity, financial performance, short-term financial performance, and your liquidity is also connected intimately to your operating efficiency. Okay, so those things, please brush up on your ratio analysis, has to be very good. And let's look at it now. Analyzing spreading financial statements. So you should have the confidence to put it on a spreadsheet, various financial statements, like here, what you see here. And I don't know where all these things have gone actually. I haven't used this for a long time. Okay, it's taking you to the website. That's not what we want actually. We want to see the financials. And yeah, we want to look at things like operating margin. Let's see what it does if I click on operating margin. Okay, fine. It's just a highlight here. But anyway, so find out the ratio. I just wanted to take you to the there's a link to a Reuters set of split of ratios, etc. So various types of ratios. So liquidity ratios and operating efficiency ratios are your main focus. Go through all the information that comes out. Go and look up the 10Q. Okay, there is something called a 10Q which comes out. SEC. Let me see. This one. Okay, I want to make sure you guys have this, because you're dealing with US companies. Okay, look at this. Yeah. Sorry, no, 10K, 10Q. Please read this SEC, and so what kind of information comes out, etc. in that. So please go through that, and that's your main focus to understand all the supplementary schedules and MD&A, management discussion analysis, outlook, where the outlook comes out for the company. Normalizing for exceptional and non-recurring items, you understand that if the company has just sold a major division. So if Facebook sells, if they are forced by the regulators to sell WhatsApp maybe, okay, so they have to sell WhatsApp, then they get some big money for selling WhatsApp. In that year, they don't really count, they should not count the WhatsApp sale proceeds in their income, because when you normalize the income, because that WhatsApp sale proceed is not going to be there every year. So this is just what stripping out non-recurring items to look at core operating income. Then adjusted net worth. These are various ways to adjust net worth. Okay, you can add. There's one way to do it for insurance companies, which is basically adding the unrealized capital gains, etc. The main thing is adjusted net worth means that now you have to figure out what kind of. So if they ask you about adjusted net worth, you can ask them what kind of adjustment are you talking about, because there's also something called tangible net worth when they calculate return on tangible equity, where what they do is they strip out the uh, intangible assets. Basically, they try to reduce the denominator so that they can show a higher return on tangible equity. But adjusted net worth, what you should understand is that generally it is nothing but uh, your net worth would be the classical accounting bookkeeping book value assessment of what we have understood conceptually as net worth. Total assets on the balance sheet minus total liability, outside liabilities, that is liabilities to debt holders, not to the equity shareholders. And if you minus that from the total assets, this is what you get, your net worth. This is the accounting concept of net worth. Now, adjusted means you can now adjust it in many ways. So one of the ways you can adjust it, as I said, in the case of tangible equity calculation, what they do is instead of subtracting this from total asset, because then if you subtract total assets might be $100 and you subtract your maybe outside liabilities is $60, so your net worth becomes 40. Then you have to take return on $40. The denominator is quite high. So you want to reduce the denominator by showing a return on tangible equity. So this adjusted net worth is basically various ways of adjusting the net worth. Okay, so I'm just writing it here. How adjusting? Okay, so you ask them, how do you want me to adjust? Okay, how adjusting? Okay, so various ways of doing it. Okay, you can actually add unrealized gains, etc. Gains, losses. Add means actually adjust by. Okay, add, subtract. Then or okay, uh, strip out intangible assets. The one I just mentioned. Okay, intangible assets. Spelling is all over the place. Intangible assets in strip out intangible assets in as in the ROTE calculation. Okay, ROTE is return on tangible equity. Okay, so what you do is you want to show return on tangible equity means this is going to be your net income. Okay, the return is going to be your net income and the denominator is going to be your tangible equity. What you want to do is you don't want to show your net worth would have been normally, your equity would have been normally just the net worth figure. Okay, so total assets minus outside liabilities. But if you do that, maybe you'll get a figure of 40. Now that is a high denominator, so you may not have a high return on equity. So what you want to do is make that return on equity look good. So you want to shrink the denominator. So therefore, what you do is now you don't subtract from total assets the outside liability from total assets. You subtract total assets minus intangible assets. And so then if you do that, so if you have $100 of total assets, then maybe intangible assets are 20. And then your outside liabilities are 60. So now your total assets minus intangible assets becomes 80 minus outside liabilities is 60. So your tangible equity becomes 20 rather than pure equity, bookkeeping equity, accounting concept of equity would have been 40, but tangible equity becomes 20 because you've stripped out $20 worth of intangible assets. So your denominator is low. This is basically a trick. It's a gimmick, the Wall Street gimmick. Return on tangible equity is a Wall Street gimmick, which is basically they want to show a high return on tangible equity because return on equity is quite low. So they want to shrink the denominator, and this is one trick. So adjusted net worth means how do you adjust? Now there could be many ways of adjusting. You could also add your unrealized gains and losses on various assets, on various instruments. So the general definition would be this, that how exactly are you adjusting? So various ways of adjusting the accounting net worth. This is the accounting net worth. So how can you adjust the accounting net worth? For various purposes. Okay, so they use this unrealized gains and losses for insurance companies. There are various other things. The main thing to understand is this. So here now this is actually a profitability kind of focus usually. Okay, when you do net worth calculations, this is usually a profitability and capital adequacy kind of or capital adequacy focus. Okay, so that is also a concern, but mainly a concern with short-term liquidity. Covenant compliance. Please remember what covenants are. Covenants are when you do debt issues. This is where this thing becomes important. Yeah, here Now you will see if you go through this document, a very useful document for those who are going to go into corporate credit ratings. You must into corporate banking, any kind of analysis. You must understand this is the customer perspective. Okay, this is how your corporate treasurers are thinking about things. So please go back and read all the documents here. Okay. Right now, your focus should not be equity capital because you don't have time. But look at all these things: introduction to debt, loan finance, high yield market, IFRS issues, accounting issues. Okay, be focused for this because you don't have time. You're not interested so much in capital markets right now. Corporate crediting, very important. Credit ratings, very important. Uh, then country guys, not so important, maybe at this stage. Um, Risk management, okay, this is important, but mainly not so much for tomorrow. What are we talking about? Cash management, this is important, but again, not your really, not focused, not really focused. Debt, uh, it's not so much basically. This is mainly your focus for tomorrow is this, your corporate finance, and mainly focusing on loan finance. So clearly for tomorrow's interview, you don't worry about equity capital. Okay, remember the difference between a corporate credit analyst and I might have discussed it with you. Okay, a difference in focus between a corporate credit analyst, which is what you guys are going to be with AKP. Corporate credit analyst is focused on short-term liquidity position of the company. Okay, and difference in focus. Now, corporate credit analyst. Now, equity analyst also. You guys are familiar with equity analyst, a very high-tech position, very high-profile position in the finance world. Equity analyst. What do you see here? This stuff I was trying to show you. Here, what do you see all this here? Who's doing this? Downgrade, initiated coverage. Who is the bank here? You can see all these. These are the various so-called investment banks who are covering these corporates. So these people who are covering Pfizer, all these fighters being covered by who are these guys? These are the equity analysts. Okay, Barclays, Mizuho, RBC Capital. Who's doing this? They will have a pharma analyst, or they may even have, because the big companies are very, very big, they may have a special big pharma team. So Bank of America Merrill Lynch, the pharma analyst, he has stopped covering Pfizer. Now he has started covering it again. Some guys, Morgan Stanley has downgraded Pfizer on 30th July. Okay, now somebody has just, DZ Bank has just upgraded to the Swiss bank. They have just, oh sorry, that was BZ. I don't know whether DZ is Swiss. BZ Bank is Swiss. So anyway, so these guys have just upgraded the stock. Now this upgrade, downgrade, this is not a credit rating matter. This is usually, see, there is a credit equity price target also given there. Okay, new price target. So these are the equity analyst guys. Their focus is different from, it's also important to understand equity. So equity analysts, their focus is different. Okay, equity analysts' focus is, okay, so we have already covered. Okay, so equity analyst focus is not short-term liquidity, long-term, like Tesla. Tesla is a classic example of, um, you know, how equity analysts focus, type of focus, basically, how the stock has gone up so much, even though the company is not making that much money in the short term. Okay, long-term revenue generation. Okay, of course, later on you want profits also, but mainly equity analysts focus on different things. Okay, long-term revenue generation program, and this long-term is like really long. Okay, so very big picture, long-term focus. Whereas the credit analyst is like basically is concerned with, can this company repay the bond that is coming due in 6 months' time? That's the focus. Whereas here they're thinking about, okay, how many cars is Tesla going to be selling in 10 years time, and what percentage of the market will they have? That's the kind of thing that the equity analysts focus on, and that's what, based on that they're coming out with the type downgrades and upgrades. So the focus is different. Okay, so look at that, recurring cash flow, debt service. So please understand, again, very strong credit focus, understanding the credit, so all your debt service coverage ratios. Okay, understand contingent liabilities on the balance sheet. Okay, if you have issued any kind of guarantee for a subsidiary company, that will appear as a contingent liability on your books. So understanding if Pfizer has issued any big contingent liability, and it has big contingent liabilities. So various customizing various ratios. So ratio analysis should be like inside out. Okay, for you, ratio analysis should be like WhatsApp. And covenant compliance, covenant is what? Covenants are all the conditions that you go here. If you read a little bit about this, loan finance. Okay. Covenants are attached to debt securities also, but loan finance is basically where this is big type stuff, covenants. So the guys who are lending money will put all kinds of, especially when you have syndicated loans and stuff, all kinds of conditions. Okay, covenants are basically conditions on attached to loans. Okay, just let me write conditions with loans. Okay, so covenant coverage. Yeah, what they will say is typically they'll say that your debts, your EBITDA. Just giving an example, they will say in a typical covenant, they will say your EBITDA can't fall below 1.2 or something like that. So your accounts receivable can't be more than X percentage of your total current assets, this and that. All kinds of various metrics which they want you to be in compliance with. So are you in compliance? You got to watch that. Okay, so you got to know what the covenants are. The covenant is basically nothing but the agreement. Okay. Now, credit reviews, risk ratings. Okay, these are internal risk ratings. Okay, narrative credit notes, all credit focus, very very credit focused, as I told you, because that's the focus of the corporate banking guys. You are the research support for the corporate banking guys sitting in big banks like JP Morgan. Now, this is all general stuff, okay? That's why I'm carrying out this. Where to work. Okay, fine, excellent. Okay, fine, great. Please make sure you read. Okay, I've given you. Let me give you one more. I think I gave you this site. Okay, let me just because the normal Bloomberg site is actually gone. Uh, the normal Bloomberg site is behind a paywall now, so you don't have very very good analysis. I mean, you can't access it. Um, so let me give you this other website, this one, okay, where this one is not behind a paywall. So keep in touch with the news, okay? Please understand the news, understand what's going on in the industry. Everything's a pretty good website actually. You can get lots of. You can actually get indirectly. You can get the Bloomberg news feed, and this is actually look at the get the Bloomberg news feed. You can get this. You can really get into the details. There is some problem now with the hedge fund that's going on. I think you guys are aware of this. Um, all this stuff, all the stuff that's going on. Uh, Now you see. Now, classic work for you here. Typical work here. S&P. S&P is a credit trading company. Okay, they are downgrading the credit on credit squeeze group entities because of this. This hedge fund is having problems, and these guys have lent money to this guy. Okay, so look at this, and so maybe this is the kind of article where you want to read this and uh, get a sense of what these guys are doing. Okay, so they're downgrading the debt issues of Credit Suisse, which are out in the capital markets. Not really so much your focus because you're really doing commercial banking, but the focus of a debt investor in the capital markets and the focus of a corporate banking relationship manager providing short-term financing is not that different. Okay, in the sense that this guy, the equity analyst guy's focus is very different. Okay, so both of them are concerned with the ability to repay the debts. So therefore, solvency questions. So these are very important actually. So please read this and follow, track the news. You have to be plugged in. When you remember, when you go into the interview, your goal in an interview, you have to go in there with the objective. I mentioned this to uh, Core and Saloni was also there, I think. Kaur and Saloni and Shrestha, when they went for that Kotak interview. Again, sent them some video links and all that. So you have to go in there with the goal that you are going to blow the company away with your product knowledge, with your domain knowledge, understanding of all the corporate banking products, understanding of the business, what you're doing, and how much homework you've done. And so these guys should, if they want to hire, like maybe they had a plan to hire 2 analysts, they'll probably hire 6 because they're so blown away with the quality that they'll say, okay, we got to hire these people. So that has to be your goal, and that's the focus with which you're going to study. So I've given you some tips that you don't waste your time now thinking about equity capital or accounting issues because this is not your focus for tomorrow. But you should understand this. You should understand corporate credit ratings, loan finance, these kind of issues. Okay. So this is your focus. Now, this is as far as my input is concerned, based on what I read here. Now, if anybody has any questions, we can take those questions. Anybody? Were you guys able to hear me? Was I audible throughout?
Yes, sir.
Okay, fine, good. I hope that this was, hopefully this, most of it was actually stuff I did not have a chance to cover with you earlier. Everyone here is a finance person, so you have already gone through the material that I've covered with you. But these are all new things. Okay, please make sure you go through the SEC. You're very US focused now. Okay, I think it's going to be very US focused. How to read a 10K 10Q, please go through this. Also read, if you try to follow Damodaran on YouTube, Damodaran has also some interesting analysis, but it's okay. I would not distract you with Damodaran at this stage because Damodaran's focus is more like an equity analyst. Okay, so long-term focus, don't worry about that at this point. Just focus on short-term credit analysis. Understand what you're trying to do. Ratio analysis, spreadsheet, financial statement readings, financial statements, reading all this stuff, this contingent liabilities, MD&A, 10Q reports, this, that, and then what is the company's earnings calls, okay, what are they saying on the earnings call, then all the liquidity ratios, what is happening, detailed, and this stuff has to be like, you should be able to do it in your sleep. You should be so fluent in this, okay? So focus on that, brush up on your concepts, and do whatever you can, do your best, and let's hope we can get some real good scores here, like maybe, 5, 6 students can get hired. All of you got hired, that's even better. Yeah, so please make sure you do that. Be on time for your interview, be ready, and yeah, that's basically it. Any other questions, folks?
Sir, what are the financial metrics, or how do we know what financial metrics are there?
No, where do you see financial metrics?
Sir, custom ratios and other financial metrics.
Oh, yeah, yeah. So this is where I was trying to take you to that. Actually, I lost I forgot the link. Actually, how do we go if we uh, go through this screener?
And sir,
And
Damodaran is, sir, he explained about valuation. So, sir, what the part valuation plays here? Because, sir, this is about credit analysis. So, sir, how do
correct,
we,
correct. So that's why
how,
that's why that's why if you see, that's why I wiped out Damodaran's name, because Damodaran has some good videos on the, but that his focus is very much like a equity analyst, long term. That's not your focus for tomorrow's job. Okay, so that's why I don't want to distract you with Damodaran at this stage. Valuation is basically, what is the valuation of what? They are talking about the valuation of equity securities. Okay, they're talking about the valuation of equity securities. So, like this, for instance, if you talk about Alcoa, which is an aluminum company, what is this chart? It's not the bonds of Alcoa. It's the equity securities, common stock of Alcoa. That's not your focus. Okay, so please understand, on the balance sheet liability side, your focus is not the equity. Your focus is the debt prices, and not even the debt prices, because the debt prices are happening in capital markets. Your focus is on the stuff that is very difficult to understand and doesn't trade that actively. It's the short-term liquidity position of the company. How much operating cash flow are they generating? All these kinds of questions. Okay. So mainly your focus will be custom ratios. Of course, custom means obviously what custom is, like saying, what does Siddharth like to eat? What does Rashi like to eat? Now, how do I know that? You'll have to ask them, right? So that is custom ratios, custom for each person and each company. But then your focus here is very much credit analysis. So remember your focus, short-term liquidity position of the company. That's what you want to get a fix on. So any other financial metric which has a bearing on that. That's why I said you go through this and try to see where they are talking about. There was a link. I can't see it now. There used to be a link where it would take you to the, to the. Say for instance, let's take Apple, and it would take you to the Reuters. It would take you to the Reuters financials, okay? And they had a nice split actually. It was good to teach students. Actually, they went through the. Yeah, there you go. There you go. See that I could find that actually statements. Now you can see this. Of course, you can get this on Yahoo Finance also, and of course they're trying to sell you the upgraded version. Now here, I think I don't know whether Reuters links are still there, but it would take you to insider trading. Okay, fine. These are all the open in Reuters. Now look at opening in Reuters, and let's see this now. Okay, so I remember this. So when you're talking about ratios, here you will see some financial analysis. Here, financial. Now key metrics. So that something like this, okay? But always remember that key metrics could be, this guy has a general focus at this point, okay? But remember, your focus is credit analysis, short-term liquidity position. So I think now you guys are smart enough to figure out what are the liquids. Go and read Pandisar's book also, which has all the ratios on the ratio analysis part of it, okay? So read any other corporate finance textbook which talks about all the ratio analysis, various types of ratios, basically trying to figure out operating cash flow generating and also the soft issues, the stories, okay? Now everything may not come out in the ratios. Do you know anything about like this? Where is this? That Bloomberg news. Yeah, downgrade on. Did you hear anything in the on the grapevine or something that Credit Suisse has a lot of exposure to these kinds of hedge funds? Like Yes Bank, we knew had a lot of exposure to these new energy, solar energy companies and all that. Do you have any kind of qualitative information that gives you a warning that something bad might happen? Those kind of issues, okay? So all kinds of, all very much focused on the company's ability to repay debts as they come due. Okay, has there been any proceedings in the bankruptcy proceedings? Okay, I don't want to talk about IBC 2016 for India because your focus is not going to be India. So we opened in Reuters. Where is this now? Financials. Okay, if we go to financials, you will see what is this now. Yeah, look at this. Now look at cash flow generation. Very, very important. What is the cash flow generating focus? You know. So performance of this company, okay? Very different from equity analyst. Equity analyst is talking about big time market share, big global issues, okay? Long term, what are they going to have? What percentage of the electric car market will Tesla have in 10 years time? You're not concerned with those kind of long term foresight. Your focus short term, can they repay the loan coming due in 6 months? How is their cash flow generation? These kind of things, okay? Look at this, what they have. They have a section where they have ratio analysis. Okay, I think they will have, not really, they've rearranged some of the stuff. Okay, key metrics, maybe they'll put it under metrics. But let's look at this. Okay. How do you arrive at the cash flow statement? Just basic theory. This is what I mean by, don't mindlessly do these people we are encountering in the admissions interviews. We have done a course on financial modeling. If you ask him some basic finance concepts like ratios and stuff, he can't answer because all he has done is done some, it just fiddled around with the spreadsheet. The spreadsheet is just a tool. Your concepts have to be clear. How do you arrive at a cash flow statement? What are these non-cash expenses? Okay, what are deferred taxes? All these kinds of things. Your concepts must be very clear. Okay, so work on all these matters, and then maybe you can see under key metrics. They used to have a nice split of different types of ratios. Share data, price, volume, value. See, look at this valuation. Now you're not really concerned with all this, okay? As a credit analyst, you're not concerned with all this. Price means price of equity. You don't really care about all that as such, unless of course this is very badly. This is very, very low. Very low equity prices means there's some problem. That means the debt is also in trouble. Okay, but generally in this environment, you're not concerned with the Fed is flooding the system with money. Okay, Fed policy also, you have to have an understanding of the macro environment, how it has a bearing on. You can bring that into your analysis. All these elements. Okay, financial strength. Okay, some of these things are important for you. Look at are they talking about margins, management effectiveness? See, this is why I wanted to take you to Reuters. Okay, I'm going to put this in here, and then I will do it right now. Uh, key metrics. Let me do it right now here. And okay, I'll do it later. I'll share it with you guys. I'll share it with you guys later. I'll send you the link with the email. All right. So everything that I've written here will be available to you. And see all these ratios. These are now. This is why I wanted to share it because I felt it was good for teaching students. Various types of all these things. Now these are very important. And receivables turnover, inventory turnover. These are operating efficiency ratios. They're talking about is management effectiveness. These are operating efficiency ratios. These have a very strong bearing on credit quality. Okay, so therefore you have to focus on these. Valuation you don't really focus on in the credit analysis unless it's very low. Then it's a warning sign. So margins are important. Okay, profitability cushion, growth percentages. Okay, you can see all this. You can do basically this kind. So go through all this stuff. You can do all this. That I think that's more than enough. Yeah, basically, I want it's the same thing that I've been telling you guys from the beginning. Okay, you need to be totally immersed in the ocean of finance. You should be absorbing everything that is coming out, constantly playing with all these kinds of ratios, thinking your concept should be very, very clear. Okay, and then all the time you do this, if you bombard your brain like this non-stop for 2 years, none of you here is stupid. All of you are bright people. The real problem is that nobody is working hard enough. Even the people who I see are working quite hard are still not. I would like them to work harder. Okay, so there is no such thing as I'm working hard enough. Okay? You're never working hard enough. So therefore, you have to put in that bombardment. Your brain has to be bombarded with information, and then it will automatically adapt to it. Okay, right? Yes, Siddharth, does that help you? Does that answer your question to some
Yes, sir.
extent?
Yes,
Okay,
sir.
okay. Yeah, key metrics, right? That's what we're looking at. Okay. Yes. Anybody else? Any questions? No. Okay, yeah, we have almost actually we have been on for almost 1 hour, uh, and as usual, I've been talking for 1 hour. Okay, yeah, okay, never mind. That is what we are here for. Yeah, you see this tangible book value I was talking about. This is the Wall Street gimmick. This is basically what they have done is uh, now they have tried to strip out the intangible assets, and so you're subtracting from a lower figure. So your net result is obviously lower, and your denominator is lower. So you can now show, oh wow, I got a great return on tangible equity. But if I actually use the actual net worth as the denominator, then your return will look much worse. But these are all Wall Street gimmicks. That's why they have these things called non-GAAP earnings. But these gimmicks are not so much for these are more for the equity guys. These are kind of these are basically meant to play with this, okay? Because this is what happens in the market. This is what you're playing. Okay, this is what many of the companies are manipulating the share price, and so this is the game that is being played by the management by manipulating the earnings and talking about all this non-GAAP earnings and all kinds of garbage. This is basically it. Okay, so you can see that's what they're playing. This is the equity price. You're not really so concerned unless it's very, very low, which is a sign of trouble. That means your debt is also going to default. So that's the thing. Okay, all right. Any other questions? So if not, nothing else, then we will end it. Are we done? Anybody? Everybody? I hope everybody's awake. So everyone has joined. So we have assumed that everybody's awake. So that's good. Okay. So are we done then, guys? So can we close it? So some of you didn't show up. Utsav did not show up, or somebody else didn't show up. Okay. Shall
Sir,
we?
because he is not eligible to actually give the interview tomorrow, and sir, me also. Because sir, we have been selected in WNS. So that's why.
You have what? You have what?
So we have been selected in WNS, like Utsav have also been selected in WNS. So he won't,
Okay.
like the placement cell isn't allowing us to give an interview
Okay.
tomorrow.
Okay. Okay. What is WNS?
Sir, I don't know the full form, but sir, we have been like Utsav is selected in business research as a senior associate, and I have been selected as senior associate investment banking.
Okay,
Yeah.
okay. Achha, the other thing I wanted to say to you, Siddharth, and also anybody else who's interested, why don't you guys also follow or take some initiative on your own? I don't know if I mentioned this to you. There was a webinar which we had, on the budget, where there was this gentleman called Mr. Sinha, I think, from Systematics. He is running equity research or some research, institutional research. So these guys who are appearing in our webinars and all that, please chase up with Faraz and anybody else and try to find their contact. I don't know these people, but Mr. Dhananjay is something. I think his name was Dhananjay Sinha or something. I remember. So I remember I was thinking of Siddharth when I saw this guy because Siddharth had mentioned how he wants to be a equity analyst, and so it struck me. So why don't you guys do this? Not just Siddharth, but everybody else. Please follow up on these. You get what I'm saying? You have to
Yes,
take
sir.
the you have to take the initiative. You see a guy appearing on a webinar, so somebody obviously called him. Either Rajiv sir called him or somebody else called him. So there is a contact somewhere in the organization. Go chase it up. Say, I want to be interviewed by this Mr. Sinha of Systematics or whatever. Okay. You can do that. Go and ask, see where the contact is, and try to push and follow up on that. Okay. All right. So please take initiative to do that, and yeah, we'll see about what happens. Okay. All right. Okay. So we'll end it now. No more questions. Okay,
No.
everyone. Okay, I'll end it now. Then we'll stop sharing, and I will send you the website link just now. I'll send you the document link uh, right now in the email. Okay. All right. Okay. Take care. Bye. Good night.
Thank you, sir. Good
Okay.
night, sir.
Yes, sir.
Good night.